So my name is Ken Moore with Global View Investment Advisors. Today's topic is indexing the best way for me to invest? And it's a very timely topic for a couple of reasons, but specifically I just got back. Last week I was in Toronto, Canada, and I spent some time with the Chief Investment Officer of Morningstar. So I'll give you his view on this topic. Let me just start off from the beginning here. Vanguard, John Bogle have popularized the idea that investing in an index where stocks are weighted by their size or their market capitalization is the best way to invest. The thesis is that returns are attributable to how much market exposure you have. So if you have 80% in the market, you'll get a better return than if you have 60% over the long run. People following these strategies basically believe this is the only determinant of risk and return. Indexing has two things going for it. First, it's cheap. Second, it's easy to understand. It's what everybody on TV talks about. It's what people reference. When people talk about the market, they're talking about market capitalization weighted indexes. Market capitalization weighted indexes are reconstituted according to rules set by the creator of the indexes, Standard & Poor's in the case of the S&P 500. The main rule is that the bigger companies get a bigger weight and smaller companies get a smaller weight. So if companies get large enough, they get in the index. If they get too small, they get thrown out. Companies that experience a rise in their price are given a higher weighting. Companies that have a price that fall are get a lower weighting when the index is reconstituted. Because market capitalization weighted indexes are weighted by price, they're essentially momentum indexes. As long as the road goes downhill, they do very well. Over the last 5 or 6 years, they've generally done very well in the United States. That's not true in the rest of the world. But anyway, the reason why we question this approach is that it weights investments by their price instead of by their value or something fundamental. When you weight by price, you definitionally own more of the expensive stocks and less of the cheap ones. The road's not always downhill. We'll talk about that later. Indexes have become very, very popular over the last several years during this period of ahistorical low interest rates and quantitative easing, which I believe has caused the indexes to do so well and caused the bigger companies within the indexes to do even better than the other companies in the indexes. Over the last 20 years, the amount of money invested in indexes has grown from 55 billion, which was about 4% of all equity mutual funds, to 4 trillion, which now is 34% of all funds. Proponents of indexing believe that information is perfect, and because no one individual has better information than another, it's not possible to get better performance than an index. They believe the only factor that determines performance or risk is how much exposure you have to the markets. Well, when I started at Merrill Lynch, I remember reading Fama French work that there are 2 factors that have resulted in higher returns than a simple market cap weighting. Eugene Fama won the Nobel Prize for this work, and he showed that the 2 factors are size, small companies do better, and valuation, cheap companies do better. So ideally, over the very long run, small, cheap companies should outperform the market, which should outperform large growth companies. But these are somewhat arbitrary terms, value and growth. Here we're talking about the price to book value. So expensive companies on book value. So in this world, there are 3 factors: how much you have in the market, how big the companies are, and how cheap the companies are. Well, in 2012, a guy named Robert Noby-Marks, Professor Robert Noby-Marks, did some research and wrote a paper that validated that there's a 4th factor: quality. Quality companies, in his work, are companies that consistently show high profitability represented by return on assets. Dr. Marx's work was so powerful that even Eugene Fama adapted his model to it to incorporate quality. Dimensional fund advisors and other indexers also use this factor in their indexes now. This is the first change to this 3-factor model since 1972. His work showed that it might be possible to reduce risk with the quality factor alone. So in other words, if you look at companies that are high quality, they might have a lower downside risk during the difficult period of the Great Recession. And he further showed that you could get a higher return and a lower risk by picking those 30% of companies that have both, that are both cheap and highly profitable or good quality. So, we haven't been able to replicate these on our own, and I'm not going to question his work, but I think that this might be too much to ask for, that you get a 13% return with only 13% downside risk. Whether you believe the degree of this or not, the effect here is quite obvious. So the problem with rote investing is that it's a great way to avoid thinking. So substantially lower downside risk can be found if you avoid trouble spots in the world, if you have a go anywhere around the world, any size, and you're not arbitrarily limited. We know, for instance, that avoiding certain areas of risk would have resulted in substantially better returns historically. Japan became, in 1991, 44% of the MSCI World Index before it crashed. During the dot-com bubble, technology stocks rose to be 33% of the S&P before the NASDAQ crashed and they fell to 10%. From 2004 to 2007, we actually experienced this. We did not own finance stocks. We didn't own banks in any of our strategies. So we didn't suffer the huge downturn that happened there. Furthermore, most of the managers that we like avoided emerging markets until 4 years or 5 years ago. So if you look at this, if you are in a market cap weighted index, then you are by definition going to own more technology. In the end of 1999, technology grew from 19% to 33% in 1 year before it crashed, back down to 10% a little bit later. And finance stocks in 1989 were less than 10% of the index. They slowly rose to 2006, to mid-2006, over 20%, to almost 22, 23% before crashing down to 11% in 2009. We don't think that's a smart way to do it. Momentum goes up, something small gets bigger, bigger, bigger until something different happens. What that difference is usually there's a recession, there's a bear market. So you get great periods here, but you see they're followed by difficult periods. So if you invested in early 2000, you wouldn't have been back to even in the S&P 500 in 2006. You would have gone back up again in 2007 to fall again in 2009. So truly, if you invested in 2000, you wouldn't have been back whole again until 2011. Similarly, if you invested in October of 2007 into the US S&P 500, you would have been back to even again in late 2011. And that we consider to be very risky. The reason why this happens, in my opinion, it's not really my opinion, there's science to prove this. We're human beings. We do not think like rational actors. We're not Vulcans, we're not on Star Trek, we're not computers, we're human beings. We have this part of our brain, this crocodile brain, this hind brain that causes us to react not only wrong most of the time, but in certain situations, we're predictably, perfectly irrational. So we think with our crocodile brain. And what that does is that if for the last 20 years, the market made 10%, if we look at what investors in the market, in equity mutual funds and equity funds did, they made about half of the return of the market because they bought and sold at the wrong times. Similarly, even in bonds, if the bonds made 6% over this period, which we had a roaring bull market in bonds, the average Joe in a fixed income fund made less than 1%. It didn't help to be in an asset allocation fund either. So your 2020 funds, your 2030, 2040, investors didn't get good returns in those either. They didn't even keep up with inflation. So why does this happen again? We do exactly the wrong thing at exactly the wrong time. And we can look at 4 periods here, 4 of the worst underperformance periods by investors in funds. We see October 2008, the S&P 500 for that month was down 16.8. but the average Joe in a fund lost 24%. So we know this. We pick the exactly perfect wrong time to get out or get in. Similarly, it happened in 1987. It happened in September of 2008. It happened November of 2000 when the market was very, very tough period. So we even know, for instance, that the largest fund available is an index fund, the Vanguard S&P 500 index. There's over $200 billion invested in this fund by both retail and institutional investors. Retail investors in 2008 sold $24.5 billion at that time, which was 63% of the year-ending value of the fund. And those same investors made, on a 15-year period, a little over 3%, when the fund itself made over 5%. So the experience of the largest fund of investors in the largest fund for the last 15 years is that they made 3.2% per year. Now, we know that there are other ways to invest than indexes, and we know we have the experience of Warren Buffett. Warren Buffett has written letters to shareholders since 1965, and in these letters we have documentation of his performance as well as the performance of other super investors. So one of those super investors was John Maynard Keynes, and we find that Mr. Keynes had a tough period here from 1927 to 1931, but then he did incredibly well, so well that he made over 10% per year for this period, during a period to 1945 when the UK stock market made zero. So there was zero nominal return in the UK market. Keynes did very, very well. We know this from Warren Buffett's newsletters. We also know from Warren Buffett's newsletters that he wrote something called The Super Investors from Graham and Doddsville. I think it was in 1984. And in that letter, he said, well, you know, why am I doing so well? Why did I make 22% per year so far? He said, well, it's not me. It's because I look for companies. I follow something called a value investing approach. I get companies that are selling for prices that are below what they're worth. He showed Tweedy, Brown, Sequoia, Walter J. Schloss, Munger, and Pacific Partners also had incredible returns. So their average was 22% per year. During a period when inflation was high, 8.5%, we're still making well in excess of 10% real return, maybe 13, 14% real return. An incredible feat. So we have this very nice anecdote, at least. We know also of two other super investors I'm going to talk about a little bit more, but on this slide we see First Eagle Global Fund, Jean-Marie Abelard, an investor that I discovered in 2000 that I used with my clients when I was at Merrill Lynch, 2000 to 2002, thankfully, and that we've used for a number of years. So the thing is, Jean-Marie doesn't run this fund anymore, so I'm not touting the First Eagle Global Fund, I'm touting Jean-Marie Abelard. And you can see here that over a period when the S&P made less than 4% per year, he made 11.5% per year. And he did it by doing well 2000, 2002, and by not doing nearly as poorly as the market in 2008. This is actually his successor, Matt McLennan. But if we looked directly just at this first super investor, Jean-Marie Abelard, how did he do this? He did it by, first of all, he was looking for things that are cheap. Second of all, he was willing to go global. Third, he would buy any type of company. It could be a small company or a big company. And frankly, for most of this period, this was a pretty small fund. So this anywhere, any size valuation by a strategy, in my opinion, is a far superior way to investing than Warren Buffett's, where he's almost solely focused on the United States. This illustration shows from 1979 to 2007 that Jean-Marie Abelard made 15.7% per year when the market did very well too. Remember, this is before the market crashed again that second time, 13%. And his performance lagged in the 90s. You can see here that the market went straight up, the red, and then it went straight down so that he was ahead. So this is something that is going to happen a lot. The next super investor I want to talk about is a guy named Robert Gardner. And Robert started as an intern with Brigham Young University in 1986. He worked his way into an analyst position and became a portfolio manager. I met Robert in 2013, and I'd known about him since 2000. I knew about him because he managed a fund called the Wasatch Micro Cap Fund that I wanted to buy in 2000, but I couldn't because it wasn't available with my employer. And the other thing is the fund was closed, or shortly thereafter it was closed, because it couldn't manage an unlimited amount of money, which is something that all these managers share. We'll talk about a little more from my Morningstar Symposium last week, but he made 25% per year when the market was up 11. It's only partially attributable to any index. I believe he added value through stock picking. He ran another fund, Wasatch Small Cap Value. He made 18.3 versus 6, or 11.6. Another one, he made 23. The market made 13. The other index made 17. So the thing is, he stepped down from his positions because his employer, the guy who brought him in as an intern at Brigham Young, when he was at Brigham Young, asked him to be director of research in January 2007. So he stepped down from those funds, but he really did not like that job. He didn't think, I later learned, that he could implement the research team the way that he wanted to do it at the existing structure. He certainly didn't have anything negative to say about Wasatch, but at the same time, he wanted to manage money. So he started a fund called Wasatch Global Opportunities in November of 2008. Our clients who've been with us since 2009 know that we bought this in a meaningful fashion for clients in, I think it was April of 2009. This new fund handily beat his predecessor funds and did incredibly well during the economic recovery. So Robert's dream had been, again, he wanted to be managing a research team. He wanted to also manage money. He left Wasatch June 30th of 2011 to form Grander Peaks when his employer, the founder of Wasatch, retired. And so he continues to trounce every index with his predecessor funds. His funds were closed in 2013 before they had any Morningstar ratings, and every one of them subsequently got a 5-star rating. It is open to 2 additional funds because his clients begged him to have a small mid-cap fund offering that would maybe do something more similar to the small cap value fund and the micro cap fund going forward. And I'm not going to predict what kind of returns are going to happen, but in terms of the relative to the market, I think there's a substantial possibility. So if we look at Robert Gardner's track from 1995 to now, putting it together the way that I showed in the previous slide, and when he couldn't manage the fund from 2007 to November of 2008, we put it in the market. He did incredibly well. It's over almost 10% per year better return than the market. I don't know how something like this can exist if market cap indexing makes any sense. So if indexing doesn't make sense, or if indexing based on price doesn't make sense, is there any other way that we can do this that might make sense? And so, again, it seems clear to me that any thinking person who sees this information wouldn't believe what Vanguard and the financial conglomerates are selling is that you should own a market cap weighted index which is biased to hold expensive stocks and expensive sectors which could get into a bubble because we know human beings don't make good investors, and etc. So we believe that value is important, that if you look at things other than price to weight an index, you might be able to, at times, construct an index that at least would be superior to the market cap weighted index. So instead of weighting the components of the index by price, you might weight it by some other fundamentals like sales, dividend, cash flow, and there are many other things you could use. So to kind of illustrate this, the market cap weighted index believes in market efficiency. They believe that any departures from market cap weight are active bets, and you never win with it. So you should be in financial stocks in the end of 2007. You should be in technology stocks in March of 2000. They don't see that there's any value to avoiding those sectors. The Graham and Dodd economy-centric or valuation view is that markets are constantly seeking fair value. Prices are never right. They're rarely right. Companies get overpriced and underpriced, and the market itself makes active bets by its momentum-based weightings and owning all sectors. So if you were to construct a fundamental index, you could do it a couple different ways. You could use sales, dividends, buybacks, retained cash flow, or sales, cash flow, dividends, book value, as FTSE does. To illustrate this, if there are two companies, both with the same fundamental characteristics, using the Russell way of developing a fundamental index, they would have the same operating cash flow, the same adjusted sales, the same dividends and buybacks. In this case, you'd give them both a 2% weighting in this example. But if we looked at it by their actual price, the earnings growth, PE, and the price, on their cap weighting, we give them the first stock A a 4% weighting and stock B a 1% weighting. So we give it twice the weight, the first stock, and we give half the weight, the second stock. And what this means is that relative to the cap weighted portfolio, the fundamental weighted portfolio has a value tilt. Relative to the economy, the cap weighting has a growth tilt. So we see big differences among holdings between these two different approaches. And again, our thesis, our belief, is that prices will mean revert, that prices get out of whack, that this momentum, that what rolls downhill will eventually stop. There's something going to stop things from continuing along, and we've seen this many times because we know that we have market cycles, bear markets and bull markets. And so things get out of whack on the up, they get to fair value, they go down, up, down, they get undervalued. So because this happens, then there's the ability for a fundamental index to generate higher performance than a market cap weighted index would. In fact, we see that in 8 different countries, basically with the exception of Italy there being an outlier, only 0.6%, but on average it looks like we have about 2% higher performance in these 8 countries at a small asset level, and this is a durable effect that should exist even at the $1 trillion asset level. Remember, there are $2 trillion total now, I think, in market cap or in all indexes. So if this exists, if there, Research Affiliates has done 1985 to 2013 work that shows that there's substantial improvement over market cap indexing by using fundamental indexing, why in the world would anybody own a market cap weighted index? So I guess that's a question I can't answer because it doesn't make any sense to me. Another way of applying the quality effect by Morningstar is something they call Wide-Moat Investing. And Morningstar has a team of analysts, about 120 analysts. And these guys spend their day looking at about, I think it's something close to about 2,000 companies that they cover. They only cover the companies they believe are worth covering, that are companies that are the better companies of the entire universe. And most of those are in the US. Of those companies, they give about 300 of them a wide moat. Wide moat, moat is a term coined by Warren Buffett. A wide moat means that a company has a sustainable competitive advantage for a long time, or expected to have a better way of earning profits than its competitors for 20 years. So it would be a wide moat company. Narrow moat would be 10 years. Anyway, these wide moat companies are very high quality companies. If Robert Novimarks, who did the quality work which affected the way that indexes are constructed in some cases, I think this is a reasonable way of looking at it. They're going to have a higher return on equity. They're going to have a higher return on total assets and higher profitability. So we can see the benefit here. And this is something that we have a way of implementing this strategy, which is a high turnover strategy and a very volatile strategy. It's very risky in the short run. You can see that from 2007 to 2009, it was down almost as much as the market, which was a horrible drop. But it recovered extremely quickly. It recovered in before the end of 2009. So you're down about a year and a half versus being down 5 years in the S&P 500. And that index, since that index has been created in February 2007, has made 10.6% per year, while the market made 6.4, over 4% per year excess performance. And you can see that it's durable. In fact, if I showed you quarter to quarter, it typically outperforms the market every quarter. So this is a nirvana kind of thing. It's a very, very good investment. We now use this. We have a way to do it in IRAs that we do for clients. And I very strongly believe in this. And it's, in fact, why I've been spending so much time with Morningstar. Based on this work, and looking to see how much time I have, we created some stock portfolios. The portfolios, there's really three of them that we're using. One we call unconstrained, and one we call margin of safety, and the other one we call, which is margin of safety value, another one we call great businesses. So great businesses is the lowest risk of the three, and great businesses Focus 20 is the one that's easiest for us to implement, and the one that we've been implementing for most clients in the last couple of years. So we also do the margin of safety focus, which is the recent numbers aren't as good. It's more of a value bias, so it took a little bit more of a hit last year, as all value strategies did. But the Focus 20, which is more of a focus on the quality, the earnings growth, the ability to continue to earn high profitability in the future, has been an incredible success. It's done much better than we thought it would. And these portfolios are based on the work that I've been doing for 16 years. And then in 2013, when I went out to do that Ironman in Arizona, I visited with Robert Gardner in Salt Lake City. And after my visit with Robert Gardner in Salt Lake City, first I went to see FPA, where Steve Romick runs the FPA Crescent Fund, and the portfolio manager that I met with there, after talking about Grander Peak and their incredible history, called him a quant. Now, I don't think they are quants. I don't think it's a fair term, but the point was that he relied on quantitative research to a great degree. So, and you saw the numbers that Robert Gardner's gotten. I said to myself, if you can rely on quantitative research and get those kind of results, I'll want to rely on quantitative research. So I came back and did some research of my own, and I found this tool with Morningstar that will allow me to replicate their index, but also to put my own variables here, the factors that I talked about, as well as the moat, to combine all of these things into something that would be lower risk than the overall market, and that also might have a decent return. And so the results here have been substantially better than we thought they would be. Back tested, this shows almost a 10% annual return on a 10-year basis, which is almost 5% better than the index. This is after our 1% fee. And you can see that it was designed to be lower risk during periods of downside. 2008, half the risk basically, and it did very well steadily. 2010, 2011, 2012, very steady Eddie performance, even doing well last year when the market was down, and in doing much better than the market this year. So we're very happy with this, and I think that the margin of safety strategy lags at the moment, but fundamentally very sound. And we were, when I was in Toronto last week, I spent time with the guys who created this technology. And what they want to do with this is they would like to create a mutual fund. I don't know that we're going to do that, but they showed me a way that I could do this and create a mutual fund out of this, and two other strategies: the Great Businesses strategy and the Margin of Safety Focus 20 strategy. So it's very exciting that we have something like this that we can now offer clients that is the same cost as a mutual fund would be to them in a retail shop. And so anyway, I'm excited about that. When I was with these guys in Toronto, we talked about is alpha shrinking, okay? And so if alpha is shrinking, then maybe you do have to index. So because all these people and institutions are flocking to market capitalization index type of things. So the two guys that I met with that I was impressed by are, and I'd met Dan Needham before. Dan Needham's the president and CIO for investment manager of Morningstar. He's a guy from Australia. I met him 2 years ago in Chicago at the Morningstar conference. And he's a cyclist. He's been to tour events. He loves these things. My son races bicycles. So I don't know how I knew it, but I started talking to him about it and made friends, kind of. So I'm impressed by his approach. He thinks that you need to be you need to have a global approach. You need to look around the world, and you need to be first and foremost concerned with losing money that you can't get back. You don't need to be worried about relative performance. If you own stocks as an interest in the business, you'll be substantially ahead. He thinks alpha is a false metric, and that market capitalization weighted indexing is one of the most foolish things that you can do. And it does not believe in the capital asset pricing model or perfect information. So, you know, he admires to the same degree Jean Rievillard, I think. The other guy who was there is named Jeff McDonald. He manages a bunch of funds in Canada. So we can't see those funds here in our, they're not sold in the United States, but his funds have done very, very well. He also worked for Trimark 1998, and he had experience working with companies that wanted to change the way that he invested money, and I think that had a very formative effect on him. So what he said is that hardly any investment managers are truly active managers. So when you look at mutual funds, particularly as mutual funds grow larger, those mutual funds look more and more like an index for a couple of reasons. The first reason is they have to. When you're so big, when you're 60 billion plus, when you're 40 billion plus, and you're investing, you can only invest in the large cap universe. You cannot own smaller companies in a meaningful way to own a meaningful position and be able to exit from a meaningful position without moving the price of the stock. So that's the first thing. The second thing is, most of these people work for publicly traded companies, publicly traded mutual fund companies, financial conglomerates, and other companies who have shareholders and other interests that force them to look at the money management process as a management of other people's money process. So what that means is that these people are not managing money like they would themselves. They're instead managing it according to some kind of a weighting to an index. For instance, in the end of 1999-2000, they would have had technology exposure. In the end of 2007, they would have had finance and banks exposure. They feel that the manager might not feel this, but the managers of him force him to own pieces of the index so that it doesn't stray too far away from the index. And it seems to me that that's the most ridiculous thing you would ever do. If your goal is to make money in an absolute sense, if your money is not to lose money, if your goal is to avoid losing money that you can't make back. So Jeff said, well, I hope it continues, that more and more people index, because the more people that are indexing and the few people that are making active bets, the better my returns are going to be, because the more people there will be who are buying stocks for the dumbest reason possible, which is that they went up in price, or for selling stocks because they went down in price. So he said that he'd like to buy and sell from these groups. He welcomes this to continue, and I agree with him. So let's look at the example of one of the funds, and I'm not necessarily picking on Growth Fund of America, which is an enormous fund. I can't remember what its assets under management are, but yeah, you can see here that at the end of 2009, it was $140 billion. So this fund back in 1980 was the active share as a representation of how much does that fund differ from an index. In this case, it would be the large cap US index, S&P 500 or Russell 1000. So it was completely different in 1981 from the index. But as it got more successful and it grew its assets, it became more and more like the index, so that now it's substantially similar to the index. And guess what happens when you get to be like the index? It makes it harder to outperform the index because you've got a fee that you have to charge, and it gets a similar risk to the index. So we've seen this time and time again. I'm only showing this because I have one example of it. But we've seen, for instance, the case of the Dodge and Cox Fund. And I think it's useful to have this discussion right now because Dodge and Cox was a fund that did very, very well 2000 to 2002. They were smart. They avoided the technology. By avoiding technology, by being maybe in some smaller companies that were cheaper, they made money over the 2000 to 2002 price. I think they were up about 40% when the market was down substantially all 3 years, 2000, 2001, 2002. So, and they were so successful that they got into all the 401ks around the world, and you might have it in your 401k plan right now, Dodge and Cox Fund. So that when the financial crisis occurred, and they had these financial stocks and as a percentage maybe to the index, I don't know this to be exactly the fact, but they had financial stocks, and I do know that they were down, I think 65% when the market was down 55%. They got pummeled, and their assets went substantially up over that period. So this analogy can be made with all of these. And I think that it's a reason, and it's very interesting, and I think very timely, that the Department of Labor recently made a proposal that starting next year, any advisor working with retirement plan assets, IRA assets, 401k assets, rollover assets, has to be a fiduciary. And you have to prove that what you're doing is better, or you have to document that there's a reason for moving money from a 401k to an IRA. And I think that a very good reason for moving money from a 401k to an IRA might be because you have smaller funds that you can invest in that are no longer like those market cap indexes, so they don't have all the risk in, especially for somebody who at a point in the near future will be withdrawing from them and will be more worried about losing money they can't make back than they will be worried about whether or not their performance looks like what the index's performance is, particularly if the index's performance is negative. So I think there's going to be we at Global View have never been this busy. We've had people calling us from North and South Carolina, having visited our website and seen the videos that we're fiduciaries in all aspects of the client relationship. Wouldn't get paid by anybody but our clients ever in cases, any circumstances, don't get paid commissions. The one bias that we have, is that we get paid more by managing more of our clients' assets. And so we have an incentive to convince them that they should put their assets with us. But that's the only one that we have. We do feel it's true for the behavioral coaching effect, but also because we can get these smaller investment strategies and smaller funds. Let me talk just a few minutes about the outlook, the investment outlook. And I'm going to reference the Morningstar CPMS, two fundamental factor strategies that they've been running since 1994, not a back test. One of them is valuation, the other one is price movement. And if you read the newsletter, I published it in January or so, valuation was down last year by 22%. Well, this is primarily price to book, okay? The factor that we know is attributable to greater performance over the long run. Price momentum is another factor I didn't discuss, but one that's real, and it's one that exists in the market cap index as well. Point is, last year, stocks that were doing well continued to do better and better. So they were up 4.3% last year, whereas cheap stocks got cheaper and cheaper. Value was behind, underperformed by 26%. So let's look to see what's happening so far this year. This year, price momentum is down 8%, but valuation is up 4%. Market's up 3% over this period. Okay, on a 1-year basis now, price momentum's down 7%, and value's down 15%. But the point is, if last year valuation underperformed by 26%, this year, so far, valuation is outperforming, I had this written wrong, price momentum by 12.3%. So valuation is outperforming price momentum by 12.3%, and we're very happy to see this change, and we think it bodes well for the future. The other thing I wanted to say is that the opportunity set is a global opportunity set. We believe in valuation mean reversion. If you look at the 5-year returns of the U.S., international, and emerging markets, you'll see very high numbers still for the United States, but low or even negative numbers for international or emerging markets indexes. So they haven't really done anything. And well, it makes sense that if you have now the price to 10-year earnings for the S&P 500 market cap weighted index is about 25. Since 1900, the 5-year return, the average, the median 5-year return later, next 5 years, was about 0.4% per year. We don't have as much data for international markets, international developed markets. We're talking Europe, Japan, Australia, etc. But since 1982, given a metric of where they're valued, which is about 16, 17, we have a return of about 19% per year. Now, this is just for the basic market cap weighted indexes. I can get fancier and look into the side of the value of this and see substantially better opportunities within the US, international, and emerging markets. But in emerging markets now, we have valuations that are around 10 or even below. So we have 15 to 20% expected return values with 11 years worth of data. So the outlook is very good for those things. The thing that you have to keep in mind is that we have these periods all the time, which I believe we've just had, where fundamental strategies underperform while price momentum market cap indexes outperform. For example, you can look at the chart of the S&P 500 in green here, and in blue, the FPA Crescent Fund. From 1988, January 1988 through January of 2000, the FPA Crescent Fund made an average of minus 1.8% per year when the S&P 500 was up 25. They looked stupid. Okay, they looked very stupid until March of 2000, when the market crashed and the S&P was down substantially. The S&P over this period, cumulative period from 1998 through 2003 now, was down, and FPA made 7.1% per year because they owned those things which were not subject to the momentum move, but then were recognized as being valuable stocks and then did well when other things didn't. So, you know, that's my fundamental core belief. I think that we know we have plenty of evidence that Vanguard believes advisors add 3% annual value from their financial planning and behavioral coaching. 1.5% of it comes from behavioral coaching. Morningstar believes that advisors add value 1.6% per year, especially if we're doing something like a stock portfolio where we're not charging any more than a mutual fund. It seems quite easy that we could add value. So our job here at Global View, we do something that we call worry-free portfolio management. We deserve, you believe, to be worry-free. It's not a promise of zero risk. It's quite the opposite. It's a transparent approach to show you where there is risk, to disclose where there are conflicts of interest. And first and foremost, what we do is we run away from conflicts of interest. The next thing is we want to invest based on fundamentals. Then we want to coach you on the volatility you will receive, the opportunity set. It will help you to make life choices. I said earlier that one of the things that our bias is that we feel the more money that we manage in viewers, the better effect we can have on your total odds of achieving your goals. And that's, so we want to try to convince you to give more money to us. So that's our bias. At the same time, we recognize that investors that we have, investors who follow Dave Ramsey and Clark Howard, for instance, like to be debt-free. So if you want to be debt-free, then you should pay off your mortgage. If you're paying off your mortgage, I can't manage as much of your money. So we do have this bias, but we also recognize that we need to be true fiduciaries and to avoid all of these conflicts of interest. One of them being that, you know, for instance, if you are looking at whether or not you should get rid of a mortgage, the question is, you know, not just can you make more than you would in the mortgage after your tax effect, but there's a worry to having a debt. And okay, it's easy to say qualitatively what this worry is, but we can even quantify this. If your mortgage is, say, 4%, then the risk premium, the equity risk premium, that I would say is something 5%. So you should make 9% on your other investments outside of that and be comfortable, have a strategy that's going to be looking to make 9% before you should own a mortgage. So with that, I'm done here, and I'm going to open this up to questions.